Hello friends, I welcome you to the next lecture on Indas. In this lecture we are going to talk about Indas 8, which corresponds to International Accounting Standard 8. The title of the standard goes Accounting Policies, Changes in Accounting Estimates and Errors. Okay. In this lecture I am not going to discuss about changes in accounting policies, and I am not going to discuss about how to deal with prior period errors, but we are going to restrict our discussion only to changes in accounting estimates. In the future lectures I am going to deal with the other topics as well, that is changes in accounting policies and also how to deal with prior period errors. So in this lecture we are going to deal with how to deal with changes in accounting estimates. Okay, so let us go ahead with it. Now, changes in accounting estimates is covered by para 32 to 40 of Indas 8. So we are going to deal with these paragraphs in this lecture. Okay, now let us try to understand the meaning of the term estimates first. Meaning of the term estimate, if you take a dictionary meaning, it means roughly calculate, approximate, gauge, judge the value, etc. So it's just a rough calculation, or we can say it's just an approximation. See, we all know the business activities are uncertain, and due to this uncertainty in business activities, there are many items in the financial statements of an entity which cannot be measured precisely. So the activities of the business are uncertain. Due to these uncertainties, it is not possible to measure each and every item of the financial statement of a business in a precise manner, that is called as an accurate manner. Okay, so in such cases what should we do? So what we normally do is, instead of trying to measure something precisely, sometimes we are giving more importance to relevance of the information and reliability of the information. Okay, so we need not worry about the accuracy of the information. In such cases, management, what they are going to do is, they are going to make a judgment. They are going to try to estimate the value. Okay, and these estimates will be based on the latest available information, depending upon current circumstances. Based on reliable evidence, management is going to try to estimate the value of that item which is going to be shown in the financial statements. Okay, so there are many situations where we are going to use estimates. Estimation is an integral part of preparation of financial statement. It does not make financial statements unreliable. Okay, without estimation it is not at all possible to prepare your financial statement. Estimate plays a major role in preparation of your financial statements. Okay, so let us try to learn more about it. Estimates are required for many items. I have given you some examples. Estimates for bad debts, inventory obsolescence. You feel that some inventory might have become obsolete, you would have to estimate the loss. Fair value of financial assets, liabilities, useful life of a depreciable asset, the pattern in which economic benefits which are embodied in a particular asset are expected to be consumed, because India 16 requires you to adopt a method of depreciation which is representative of the consumption pattern of the economic benefits which are embodied in an asset. So we would have to estimate what is the pattern in which we are going to consume the economic benefits which are there in an asset. Warranty obligations, there are many more areas where we are going to take the help of estimates, etc. Okay. Next. The use of reasonable estimate is an essential part of the financial preparation of the financial statement and does not undermine the reliability. Just because we are using estimates in our financial statement, it does not mean that the financial statements are not reliable. Okay, because estimates are based on reliable information, estimates are based on relevant information, estimates are made by the management by using their judgment. Hence, we cannot say that they are not at all reliable. Yes, there may be some, we can say, there can be a difference between what has actually happened and what was estimated, but that does not make it unreliable. Okay. Now, an estimate may need a revision if changes occurred in the circumstances. If the circumstances have changed, we have got more experience now, or because of the additional information available, the estimates may undergo a change. We just now discussed, we said estimates depend upon circumstances, information, experience. So when circumstances, information and experience changes, automatically the estimates are also going to undergo a change. So by its nature, the revision of an estimate does not relate to prior periods, and it is not a correction of an error. So we should distinguish between what is an error and what is a changes in an estimate. So by nature, changes in an estimate is not an error. So accounting treatment for changes in estimates changes in estimate do not relate to something in the past, it only relates to something in the future. Hence, we are not going to give a treatment similar to that of changes in, we can say, prior period errors. Okay, so they are not errors, we can say. Next, changes in an estimate versus an accounting policy. See, there can be situations where we will be confused between whether a change is a change in estimate or whether it is a change in accounting policy. When such a situation arises, where you are not able to determine whether it is a change, whether it is a change in estimate or whether it is a change in accounting policy, the standard gives guidance and it says you have to deal with it as if it is a change in an accounting estimate, not as a change in accounting policy. Okay, and sometimes you can see here, if you change the basis of accounting, let us say earlier you were following historical cost basis of accounting, that means all assets or many assets were measured based on historical cost. Now suddenly you have changed your accounting policy to fair value basis, that means you are going to value the assets based on their fair value. So this is a basis, this is a change in basis. This will be considered as a change in accounting policy, it will not be considered as a change in accounting estimate. Okay. Next, how do you deal with the changes in P&L account? See, because of changes in estimates, what is going to be the impact in P&L and what is going to be the impact in balance sheet. So how do we deal with changes in estimate? So what standard says is, if there is a change in an estimate which affects the P&L account, that change in estimate, if it relates to the current year, it has to be adjusted, that means it has to be considered in the current year's P&L. If the change in estimate is going to have an impact in the future, then they would be adjusted in the future P&L accounts. Okay, so that is how we have to do. So you have to give prospective effect in the year of change and prospectively. We are not going to do it retrospectively. Is it clear? Okay. Now, these changes can sometimes have an impact on balance sheet items, that is assets, liabilities, equity. So we would have to make adjustments to the carrying amount of the asset, liability and equity. If the change has an impact on the current year's balance sheet, we will change the relevant items. If it is going to have an impact on future, we can say in the future balance sheets, then automatically when future balance sheets are prepared, the changes in estimates will be taken into account. Is it clear? So we are going to only provide prospective effect, no retrospective effect. Is it clear? Now we can see some examples here. Change in estimated provision for bad debts has impact only on current year financials. Let us say we had estimated the provision for bad debts to be 5% of debtors. But before finalization of accounts, before approval of accounts, we want to change an estimate. We have got some more information which tells us that the estimated bad debts are not going to be 5% of debtors, they are going to be 10% of debtors. In such cases, we are going to change the we can say provision, we are going to increase the provision in the current year's P&L account and we are going to change the corresponding provision in the balance sheet as well. Okay. So this is going to have an impact only in current year financial statements, it may not have an impact in the future. But there can be some changes, like changes in estimated useful life. If you change the estimated useful life of an asset, it will have an impact on the depreciation which is charged to P&L account of the current year. It will also have an impact on depreciation on the same asset which is going to be charged in the future. So if you reduce the estimated useful life, automatic depreciation charge for the current year would increase and also for the future it will also increase. Is it clear? If you increase the estimated useful life, then automatic depreciation charge for the current year will reduce and also for the future. In future also the depreciation charge is going to reduce. So this is an example where it may have an impact only in current year, where this is an example where it may have an impact not only in the current year but also even in the future. Okay. Now, what are the disclosures required? The standard requires the entity to disclose the nature and the amount of change in accounting estimate that has an effect in the current period or is expected to have an effect in the future period. So you are required to disclose the nature and the amount of change in estimate which is going to have an impact on current year and also in the future. Okay. Now if the amount of effect in the future periods is not disclosed, because estimating it is impracticable, and entity shall disclose that fact. I will give an example for this point. Change in estimated rate of defects. See, a company is selling goods under guarantee or under warranty. They know that when the customers find a defect, we are bound to rectify those defects, we have to spend money to rectify those defects. Okay. So if the management estimates that the rate of defects is going to increase, let us say initially the management estimated that 2% of the products will be found defective, and their estimated provision for, we can say, rectifying warranty claims was based on this 2% rate. And in future the management changes that rate because of experience, they may come to know that not 2% but 5% of the goods are coming back because of defects, or 5% of the customers are coming back to us for warranty claims. That means now we have to change the estimate, because earlier we expected 2%, but because of experience we have come to know that not 2%, 5% of the products are being found defective. Now in such cases, this change in the expected rate of defectives can have not only an impact on the current year's provision, but it will also have an impact on future provisions. Okay, so how much impact it will have on future provisions we cannot estimate now, to disclose it in the current year's balance sheet. So current year we have changed the defect rate from 2% to 5%. So we know by how much the provision has increased because of the change in estimate on the current year's P&L account. We know the impact on the current year's P&L account. But because of this increase in the rate of defects, it may not be possible for us to today estimate what is going to be the impact on future provisions, because it will also depend upon future sales as well. So in such cases, we are just going to disclose the fact that the estimated defects rate has been changed from 2% to 5%, and it may have an impact on future provisions as well, but which cannot be estimated today. So we are not able to estimate the amount, we are not going to disclose it. But suppose if you are talking about estimated useful life of an asset, if you let us say the estimated life of the asset has been reduced, so we know by how much the depreciation rate, the depreciation charge is going to increase this year. We also know what is going to be the increase in depreciation charge for the future, that we can disclose by way of amount as well. So when it is possible to estimate the amount of change in current year and future, disclose both of them. If it is not possible to estimate the amount of change in future, you have to disclose the fact that certain estimates have changed, but we are not able to estimate what is going to be the amount of impact in the future P&L account. Okay, so this is the disclosures which are required by the standard for changes in accounting estimates. Okay, so I hope you were able to understand how to deal with changes in an accounting estimate. Thanks a lot.